Most people believe that financial markets are driven by fundamentals, such as earnings, dividends, growth, interest rates. But sometimes prices move in a very strange way, and it's not always easy to explain why and how. This is Jonathan Lebed. Between September 1999 and February 2000, he was trading stocks from his bedroom in his parents' house. He was at the age of 15. In order to see more videos like this and let this channel grow, like, comment, subscribe. Thank you. He focused on small stocks of small companies, so-called penny stocks. There's no explicit definition of what a penny stock is. You can think of a stock with a share price of, in the US, less than $5. But that's not the important point. More important is that these have extremely illiquid and thin markets. So the liquidity is low, public attention is low, and this makes these shares react extremely sensitive to really a few trades. Using starting capital from his parents, he built positions in these stocks. And after that, he posted optimistic messages in online forums. At this time, this was quite a new medium. When people became aware of these messages, they started trading, they became interested in these stocks, and accordingly the price rose, because they were penny stocks, very sensitive to small changes in demand. Prices had moved not because fundamentals had changed, but simply because attention has shifted. When the price has reached a certain level, he sold. So after a few months, he had made $800,000 US. Two factors made it easy for him. First, the internet was still a new platform, and he knew how to play it. Second, close to the maximum of the dot-com bubble, enthusiasm was high, and there was a huge interest in small stocks and earning money. Everybody was afraid to be too late and miss out a good opportunity. We call this FOMO, the fear of missing out. $800,000. Not insignificant. Certainly more than a paper boy earns. And accordingly, the case gained the attention of the SEC, the US Security and Exchange Commission, the market supervisors. Lebed was accused of having manipulated the market by misleading statements. He settled the case out of court without admitting any misbehavior. He stated, "I wasn't doing anything wrong. I wasn't posting any kind of false information." The chair of the SEC, Arthur Levitt, of course had a different view on that. He noted that Lebed appeared to have mastered an age-old strategy named pump and dump. A pump and dump is really buy, lie, and sell high. The case clearly operates in a gray area. It was never settled at court, and Lebed's lawyer stated that in the end, Lebed didn't do anything else than an analyst on TV. It shows how difficult it is in practice to distinguish between legitimate trading and price manipulation. The best-known example is Jordan Belfort. In the 1980s and early 1990s, he operated the firm Stratton Oakmont. The firm was specialized in penny stocks, so the same asset as in the Lebed case, but with a different structure. Hundreds of brokers contacted potential customers through cold calls, unsolicited phone calls, following a prepared script and creating urgency. This dynamic is also reflected in contemporary films such as Boiler Room or The Wolf of Wall Street, which illustrate how these practices have entered popular culture. You may remember the scene from The Wolf of Wall Street, where the wolf teaches his employees the psychology of cold calls. The mechanism remains the same. Build a position, create demand, sell into that demand. What differed were scale and coordination. In 2017, there was shocking news in the German and international media. The team bus of the stock-listed German football club Borussia Dortmund had been attacked with several pipe bombs. One player and a policeman had been injured. The stock price initially declined. The person responsible for the attack had bought put options, allowing you to sell a stock at a predetermined price. If the market price falls below this price, the difference is your profit. So it's basically a bet on a falling price. The deeper the fall, the higher the profit. He had purchased around 15,000 option contracts at a price of approximately 78,000 euros. If prices had fallen significantly, he would have earned millions. But after an initial decline, the price even closed at a plus. The strategy had failed. Notably, the perpetrator had used the internet account at the team hotel for his transactions, where he had also checked in. Interestingly, his transactions had already raised suspicion at the bank. Not because they anticipated this terrible crime, but because they were concerned about some kind of money laundering. Only later did the broader context become apparent. This case also illustrates that financial transactions leave traces. And that's the investigators' sharpest weapon. It allows them to reconstruct the sequence of events. On the other hand, for the manipulator, it's the biggest risk as soon as he has to become active in the market. When he has to do real transactions, that's observable. The perpetrator was later sentenced to 14 years in prison for, amongst other charges, 28 counts of attempted murder, corresponding to the number of people in the bus. The cases we have seen seem to be very different, but in fact they are closely related. In research, we sort price manipulation into 3 different categories. First, information-based manipulation, where wrong information is used to either trigger a price decline or an increase in the price. Second, trade-based manipulation, where small fake trades create a misleading impression of market demand or supply. This, of course, particularly works well with the already mentioned penny stocks, less liquid markets where a few trades are sufficient to move prices. Third, action-based manipulation, such as the attack on the Borussia Dortmund team bus, where you use a real-world event to move prices. But the pattern for all the 3 is the same. Take a position, create an impulse, capitalize on the reaction. There are 3 common misconceptions about market manipulation. The first one is that it happens exclusively in small illiquid markets. The second is that it is a feature of weakly regulated markets. And the third one is that it is confined on niche or highly speculative assets. These statements are intuitive, but while they hold to some extent, they do not tell the full story. For example, a study by Agarwal and Wu reports more than 140 cases of litigated stock market manipulation in the United States over a period of 12 years. That's around 1 case per month on average. Importantly, this only concerns the detected and prosecuted cases, so it is just the top of the iceberg. And we find similar patterns in other markets. In Turkey, more than 350 cases were transferred to public prosecutors over a period of 11 years. Regarding the highly speculative assets, well, we know cryptocurrencies are particularly exposed to price manipulation. A widely cited study by Forbes, for example, stated that up to 50% of trades on certain cryptocurrency markets are wash trades, trades that just increase volume without any economic activity. But we also know that manipulation takes place on equity markets. We have seen the example from the US. We have seen that it takes place on bond and fixed income markets, and it also, and in particular, takes place on precious metal markets. And crucially, large financial institutions with high reputation have been involved. Remember the LIBOR scandal, where most of the world's top banks have been implicated. Furthermore, traders of major banks like UBS, Deutsche Bank, or HSBC have been charged with price manipulation in precious metals markets. In some instances, the fines reached something like tens of millions of dollars. And in one prominent case, JP Morgan agreed to a settlement of approximately 920 million US dollar. Taken together, these findings suggest that market manipulation is neither rare nor limited to specific markets. Instead, it appears across different regions, different asset classes, and different levels of regulation. For investors, this raises a different question. How should we deal with price movements around important events? In financial markets, we very often observe unusual price patterns before significant developments. In some cases, this gained quite some attention. A prominent example is the terrorist attack of September 11, 2001. Before the attack, we could observe increase in option trading activity. However, investigations often cannot provide evidence for informed trading. Or look at periods of geopolitical tensions, such as between the United States and Iran in 2026. A report published by the Financial Times found that before a market-moving announcement concerning Iran, $580 million were placed in oil futures, just minutes before the announcement. However, such patterns are difficult to interpret in real time and do not necessarily imply manipulation or informed trading. We look at markets in hindsight, which can always lead to wrong impressions. So are we completely at the mercy of the manipulators? To some extent, yes. But here's a comforting truth. While prices may be distorted in the short run, fundamentals will prevail in the long run. A robust investment approach is not about fearing the noise. It is about focusing on structure, diversification, and patience. Markets can be influenced, but ultimately, value matters. Don't fall for the trap. Subscribe and stay ahead. Thank you.